Hello and welcome to Financial Data Analysis by Lisa Storm. First, we will start by going through the three basic financial statements: the balance sheet, the income statement, and the statement of shareholders' equity. The balance sheet shows the value of the assets at a point in time and how those assets were subsidized. The basic accounting equation is assets equal liabilities plus shareholders' equity. Using this equation as a basis, the top part of the balance sheet shows the assets, which equal the bottom part of the balance sheet, which includes the liabilities and the shareholders' equity. Understanding the balance sheet allows the user to evaluate the company's ability to raise funds in the form of debt or equity in order to satisfy the debt obligations. The income statement shows the revenues and expenditures that a company has over a particular period, usually a month, quarter, fiscal year, or year to date. The top line of the income statement uses revenues, or sales, incurred from normal operations, minus the direct costs such as the cost of goods sold that are involved in making these goods, which will give you the gross profits. Then, the other operating expenses, such as the administrative and selling expenses, are subtracted from the gross profit to give the net income or loss of that company. The first of the financial ratios I'm going to talk about are the liquidity ratios, which evaluate the company's capability of meeting current obligations with the assets on hand. And these include the cash ratios, which measure the company's ability to pay the current liabilities from the cash and cash equivalents. The current ratios, which measure the company's ability to pay its current liabilities with its current assets. The liquidity index, which measures the days required to convert a company's receivables and inventory into cash, and the quick ratio, which shows if a company can pay all of its current liabilities if they became due immediately. The next set of financial ratios that I'm going to be talking about are the activity ratios. The activity ratios are used to show how effectively the company is at collecting its receivables, turning over the inventory, and paying their bills, all of which can show if the company has control of its operations. The activity ratios consist of accounts payable turnover ratio, which measures how effectively a company pays its bills, accounts receivable turnover ratio, which measures the number of times that a company collects the average receivable balance in a year, and the inventory turnover ratio, which measures the number of times that it takes a company to sell its average level of inventory. The third set of financial ratios are the leverage ratios. The leverage ratios show how much of debt is used in order to finance operations. They consist of the debt ratio, which shows the proportion of assets financed with debt, and the debt to equity ratio, which measures how much of the assets are financed with debt or liabilities versus how much is financed through equity. The fourth type of financial ratios are the profitability ratios, which include the gross profit margin ratio that compares the company's profit revenue to the company's sales revenue, the operating profit margins that measures the return on sales that is generated by operations, the net profit margin ratio, which shows how profitable a company is after all the expenses, including the interest and taxes, the return on assets ratio that shows the net earnings in relation to the company's total assets, and the return on equity that shows the rate of return on the equity invested into the business. This is the balance sheet for ABC Corporation. As we can see, most of the assets come from cash, while most of the total liabilities and owner's equity comes from the liabilities. As we can see from ABC's income statement, there is a revenue of roughly $6.5 million in 2018, which is up from the total revenue of 2017 of around $5.3 million. So from 2017 to 2018, the total revenue went up about $1.3 million. However, the total expenses also went up from 2017 to 2018. So if you look at 2017 expenses, it comes to about $2 million. That went up in 2018 to $3,100,000 roughly. So that went up roughly $1.1 million. And then when you take for the difference in the income tax expense, that changes your net income to only about being up $150,000. So you can see that even though the revenue went up by $1.3 million, because the expenses also went up by almost the same amount, the net income is not that much more than it was the prior year. The next set of financial ratios we'll look at for ABC are the activity ratios. Now, only one of the activity ratios really pertains to this company because the other ratios involves inventory, and this is a service-only company. So the accounts receivable turnover ratio shows how good a company is at collecting its receivables. The ratio for ABC for 2018 is 7.24, which is down about half of what it was in 2017 of 1493. This is due to ABC's signing contracts with net payable days of 75 to 120 days instead of the normal 30 days net payable that it had in 2017. The higher the ratio, the faster the company collects cash from the customer. Having a low accounts receivable turnover is bad because it means the accounts receivable only turns over 7.24 times for the period instead of 14.93 times for the period. The next set of ratios are the leverage ratios. The debt ratio shows how much of the assets are financed with debt. This went down from 6% 0.68 in 2017 to 0.62 in 2018. This means that in 2018, 62% of ABC's assets were financed by debt. So the higher to 1 this number is, the more risk there is that a company can't pay off its debt. So it's good that it has gone down from 2017 to 2018. The debt-to-equity ratio measures what proportion of total liabilities to total equity are used to finance the assets. ABC has a debt-to-equity ratio of 1.62 for 2018, which is down from 2.13 in 2017. This is good because it means that ABC is financing more of its assets through equity in 2018 than through debt that has to be paid back and comes with extra charges such as interest charges. So when looking at a recommendation, we want to find out why did the expenses jump up so high and where they jumped up high. So as we can see from the breakdown of expenses from 2017 to 2018, the only visible difference is salary and wages. So the salary and wages went from about 1.1 million in 2017 to 2.1 million in 2018. It's almost $1 million difference. While expanding the staff might be worth it in the long run, we really need to keep an eye on the employees' wages versus the income they are bringing in, and think about cutting back on some of the current employees that are not billing the amount of work that they should.